talked about active managers, I think it was 60 or 70% weren't beating the Standard & Poor's 500 index for
Right.
the last 10 years. So,
Are you in that group?
So the inception
That
of
was
our
your answer?
firm.
you know, I needed you to
Yeah.
answer
Yeah.
because I'm emotional.
You're shy.
Yeah,
Are you beating the
yeah, you're
benchmark?
the-
I'm not
Totally
sure.
valid question. So our core equity, net of fees through the end of March versus the S&P 500, we always measure net of fees. I think the inception is February 2009. The inception of our firm was the end of 2008, but our core equity was put after the first client came in. We're down about 30 basis points. So it's maybe 15.9% on the S&P 500 and 15.6% per year with our core equity. When you take in that we can manage taxes, and you'd still have to pay a fee to index with the S&P 500, like I had mentioned, 0.1%. And so we're close. We're very close. I would say through the end of the year, through the end of 2015, if you look at those numbers, we were actually up 60 basis points per year. We trailed through February. We made up ground in March, and then we're making up a lot of ground in April. Our whole goal over, call it a 7-year market cycle, if we can outperform in 4 to 5 of those years, we're gonna outperform the benchmark.
And then by outperforming, you're including your fees.
Yep, our
and
equity, our
you're
1%
comparing
equity.
your fees, the actively managed fees, and then we are either there or above them. I mean,
Yep.
your goal is to be above them, but you
Absolutely.
can't do it all.
So we have a core equity model. We have a number of names that aren't even in the S&P 500. We've got some mid-cap names. Mid-cap names, small-cap names got beat up over a certain period of time, specifically in 2015. And whereas large-cap consumer staple companies did really, really well. So you can argue what the correct benchmark is. What we're trying to do is we're trying to buy really good businesses with niche products that are gonna last a long time, and management teams that know how to essentially effectively allocate capital. So if we do that right, we should outperform the benchmark, and our clients are gonna be really happy, and we should outperform it net of fees.
So you're buying and holding, and as long as your clients understand you're buying and holding and understand that you're not gonna make a lot of money initially, you aren't churning, so you should be more tax efficient.
Yep.
And so really you're looking at if your fees, inflation, and tax efficiency.
That's what we're looking for. We're looking for after-tax real returns, after-fee returns. So, and you know, along with the fee that we charge comes Julie's side of the business, which I think a lot of our clients would argue that they need her more than they need me in a lot of cases. But you know, I think it is important to have, you know, very sound strategy, but also try to keep your fees reasonable and your taxes low, and you know, minimize your expenses, your trading expenses. I think taxes are what can really eat up a portfolio's return.
Question, is there, obviously there's an investment advisor fee. Are there fees for the underlying managers in the asset allocation portfolio as well? So you've got to look at both sides.
Yep, absolutely. So the all-in fee on call it a balanced portfolio would be about 1%, with the outside managers' fees charging about 20 to 25 basis points total of the actual.
So you have 1.25 then, or?
No, 1% on a balanced portfolio, that was $10 million. But if you're paying a 1% fee, then it would be 1.25%, but 35 basis points on bonds helps. So, let's see where I am here, page 23. That's all I have in terms of asset allocation. I also have more thoughts on the market. I don't know if we have time for that, if there's a desire to talk about that.
So is that?
Crystal ball, what do
Okay.
you wanna know?
I'll be, Coming up, I'll be brief. So, to us, there's more of a backdrop comment here. There's 5 key drivers to the equity markets. One is the economy. Typically, stocks are gonna rise in anticipation of an improving economy and GDP growth. And then once that GDP growth is realized, stocks will already have run. So you need to anticipate that. Monetary policy, we look at that, we think it's very important. Is the Fed in a loosening mode or in a tightening mode? You could say right now that they're in a hold steady mode. Sentiment, we look at sentiment as a contrary indicator. We look at different sentiment indicators and figure out just how bloody it is out there. And typically that's when we like to rebalance and buy more equities, even though it doesn't feel right. It typically is right.
Is that like the consumer confidence index or things like that?
Consumer confidence is a decent indicator of, well, I guess consumer confidence. But we're looking more at like stock market, well, like the bull versus bear ratio, which I have a chart on that, which is pretty neat. You can see all of the when there's a maximum number of bears, it was the perfect time to buy.
Okay.
So it's more stock market. Stock market doesn't reflect reality on most days. And then valuation, really your future return is going to be dependent on what your starting point is in terms of valuation.
I had a quick question about rebalancing, because you mentioned it.
Yeah.
Do you have a specific time that you rebalance, or do you watch what's happening in rebalance at various intervals? How do you handle that?
So we typically are watching what's happening with the equity markets and the bond markets. So, you know, we were pretty active in rebalancing portfolios earlier this year when the stock market sold off. And we're not talking about, you know, adding 35% to equities and reducing bonds. We might add 5%, 7.5%, 10%,
But
still maintaining that range.
You also sometimes rebalance amongst the asset classes of stocks.
Oh, yeah, sure. Sure.
And do you do that constantly, or is that done?
Constant enough to keep turnover at 25% or below in our core equity. So I can think of, you know, our biggest holding is a company called AutoZone, aftermarket part retailer. It's 4.3% of our portfolio. We had trimmed it when it was above 800, and it's since fallen back down. So that's an example. A lot of our turnover doesn't come from new ideas, it just comes from rebalancing our core equity portfolio. And then once again, amongst growth assets, we can add more emerging markets, we can add more to core equities, international developed, when opportunities arise.
One more question, I'm
Yeah,
sorry.
sure.
Do you tend to try to keep the same approximate percentage of the different, and I'm not talking about, I'm talking within equities, same type, this approximate mix of value, small cap, large cap, do you try to keep that somewhat constant, or you're looking at the?
So for our core equity, it's completely bottom up, we call it. We don't really care what the benchmark looks like. We were really underweight oil going into when oil went down, not because we didn't like oil as an asset class, we just didn't find much value in it, and we found more value in consumer discretionary stocks like TJ Maxx, AutoZone, Dorman Products, and you know, in terms of balance sheet financials, lenders, big banks, we didn't own any of those. We finally found a company called East West Bancorp, which is a big cap bank based in San Francisco. We found that to be pretty attractive. That company is not in the S&P 500 index, but it's going to grow a lot faster than the JP Morgans and Wells Fargos of the world. So we're very bottom up, and we own some very big companies that everybody in this room would recognize, but then we own a handful of companies that probably nobody would even have heard of before. And I think the smallest company we have is about 1.5 billion in market cap. So
Wonder if VCA is in your portfolio?
we owned it in small cap at Lowry Hill at my previous company. My friend, portfolio manager Cam covered it, and they still hold it actually. So the ticker is WOOF.
Yeah. So, let me ask you a question. So right now, everybody in the room is gonna get a big lump sum of money in the next
Yep.
few weeks. We're gonna have that. And now we have a big election coming, which looks like it could be very interesting.
Right.
So what do you recommend as far as people investing all of that money, some of that money, hold money back and wait and see what happens, or like, what do you, I
Yeah,
recognize
right.
balance stuff, what do you, how much would you hold on the sidelines until you see
Right.
what shakes out here?
So policy for us typically, it's to invest half, because typically over long periods of time, the stock market goes up. But I think we're probably in more like the sixth or seventh, maybe seventh and a half inning of the current economic cycle. So we're getting a little bit closer to the end. Plus valuations have really shot up recently. So when you get the cash, you're gonna have stock market valuations at near all-time highs. You're gonna be, above 18,000 on the Dow. You're gonna be at, 2,100 on the S&P. I wouldn't advocate putting half in. I would advocate putting a quarter in. And
Okay.
then over time, see what happens with the election.
Okay.
The summer, there is an old adage, sell in May and go away. There's some truth to that. A lot of people are on vacation, volatility creeps up in the market, strange things can happen. People wanna close out their stock portfolios before they leave for vacation. And that typically means that you run into some weaker months in the summertime. So that might provide some nice opportunity. And if you think of what happened last August, with the Chinese currency situation and their sudden devaluation of their currency, that caused huge ripple effects in the market, and that was, in hindsight, a wonderful time to buy. So investing on air pockets with the remaining cash is probably a good idea. But I think to get started, at current valuation levels, all the uncertainty, quarter to a third.
Okay.
And then move it in over the next 6 to 12 months,
Right.
the remainder.
Right.
When you really feel like you don't want to, that's the best time to do it.
So you talk about investor sentiment and,
Sure.
may go away,
Yeah.
that kind of stuff, and where he talks about the Super Bowl and,
Yeah,
elections,
right.
and there's all kinds of little tricks, but,
Yeah.
the majority of us, I think, aren't really, sentiment is not involved. Most of us have our money in the market and it stays there, and it's the.
Long term.
It's the institutional investors, it's the day traders, it's computers doing the trading and computers don't have any sentiment.
Right.
So, does that really play a part anymore like it used to?
It shouldn't, but, it's, volatility can creep up from a lot of odd places. But, if everybody has a long-term time horizon and you're comfortable with the volatility in stocks, you can probably invest more to start out. It makes sense, too. And I completely believe that the market should not price 5 days a week.
So I've asked this from several CPAs, I really haven't gotten a straight answer. So we don't really owe tax until October of 17 on this money. So, I guess there have to be some quarterly payments that have to be made, but if you don't make them, you get penalties, could you possibly get a better return on the money, keeping it, investing it anyway? Is this just all CPA, your individual CPA's recommendation? What is the general rule? So June 15, we have to do quarterly payments on this money, right?
And you could base that up on last year's tax number.
Wow, so so we have this money for
So-
over a year to invest, this taxable.
So what's your 2015 taxes due that's completed, not just guessed at? You can do 110% of that number in your quarterly payments for 16, and you wouldn't have any penalty at all.
That holds true even with a windfall like
Yeah.
this?
No, windfall doesn't
John,
matter.
I know he's gonna answer that question, okay, and
So-
he was very.
But you still have to have the money available when it comes time to pay the taxes.
Yeah.
You don't wanna put it all in, have the stock market go down.
So the safe harbors, as I understood it, was the same thing, 115 or 110% of last year, 90% of this year. But when we talked about that and Owen was sitting there, and everybody knows Owen, he had a difference of opinion, and I'm not sure why. But I always thought that was a safe haven, whether there was a windfall or what have you, as long as it was 110 of last or 90 of this, you're covered.
90 this year.
90 of this year or 110% you're saying of last year,
Oh,
and then you're covered.
Okay.
I can tell you that one of my accountants said, if he puts his accounting hat on, you're supposed to pay your taxes in the quarter that you earn the income. And then he said, then you take that cap off, you pay the 110%, so you stay under the radar, and then pay your taxes April 15th, and just put it in a CD, something super safe.
October 15th.
No, you have to, no, you have to pay.
You have to pay it in April.
You have to pay by April. I don't follow the terms.
File in October.
Well, the only caveat on that could be, is if I'm not mistaken, California has a different twist on that for California state tax, or you're just referring to federal when you.
I'm just talking about federal.
Right. So because I'm pretty sure California does want to see the deposit in the month it's arrived, or, you know, they're gonna come have somebody show up your doorstep and drag you out.
There was an article in the Wall Street Journal about with the debt being so huge now, it's gonna be 5% of GDP soon, and so they were saying that no matter who wins the election, taxes are going to go up. So I assume that would have a chilling effect on the market. So that might play into next year too, when you think about how you allocate.
I think so, yeah, and it's the budget deficit of 5%. You know, we've had higher multiples in the stock market when marginal tax rates have been higher than this.
It doesn't always make sense.
A lot of investors don't pay taxes. A lot of institutions obviously don't, endowments and pensions and things of that nature. So it might have an initial impact, but over time it seems like things kind of sort themselves out. Do we want to continue on with this, or do you want to?
Let's check.